Are the markets matching the temperature? It is December, it is cold, temperatures are down, and looks like markets are too. But joining me to brave the winter is, of course, Stephen Guilfoyle of Sarge986. Stephen, thanks for coming out today.
Thank you for having me. You think it's cold?
Actually, no, not really. But, our viewers don't know that.
I think it's kind of nice.
It actually is quite refreshing, especially having you on the street with me.
Gosh, thank you so much.
Of course. Well, let's talk about DJ Finance, because he's certainly turning the table since we last spoke. Stocks are down. Have you shifted your portfolio at all?
What I did was, last week when a couple of technical levels did break, I took profits in a few names. I didn't get out of these names completely, but I trade around the position. So I took profits in names where it needed to be done. I just got back into one of them yesterday, Lamb Research. I had sold about 60% of my stake when it crossed through to 197 on the way down. I bought back about half of that yesterday, around 182. So we got a nice we saved ourselves $15 on part of that position. I also traded oil this week pretty well, I guess. I mean, that sounds like I'm bragging, but I guess it was pretty well. My Schlumberger and my Apache holdings, which I actually explained to you guys last time we were on, oil peaked on Monday, so I got a high price around the open for both of those names, and I sold a third of the Apache and about a half of the Schlumberger at the same time, and oil's come in ever since, so that looked like it was a decent move. So, yeah, I'm moving things around, but I'm basically in all the same names.
Okay, cash positions? Cash
is higher, okay? I had gone to, really, for me, an incredibly high level of cash. Right now, I just looked at my portfolio. I'm at 48% cash right now, which for a Wall Street guy is insane. I usually am on the high side for cash, but I usually keep it to around 20. But I sold a bunch of names over the last month or so, and I redeployed some of the capital. I had gotten cash down to about 33% going into late last week, and then some of the technicals just started looking wrong late in the week, especially in the tech names. That's, of course, tax-related, but that prompted me to take it to a higher level for now.
Yeah, that sounds kind of alarming, Stephen.
Yeah, well, just for now. It's just because I had a lot in tech, and with what we're seeing with the tech space, this is tax-inspired, okay? The tech space is the one that will see almost no gain from the tax reform, and with the corporate AMT, they're actually going to see some harm. Now, where's the money, right? California, New York. If you live here or there, you're going to see your taxes increase. So what are they going to do? They have big profits. If they were going to sell these profits next year because they thought they might have lower taxes, now they got to drag that selling into December. So now we have a December to remember, maybe for the wrong reasons if you're long the tech space. However, now you're seeing life in retail, financials, even energy, although that's been lousy the last couple of days. But these are the spaces that have paid 30 to 35 to even 40% tax rates. So they're the ones that are going to see benefit. That hasn't worked out for the Russell so far, but that's what I think.
All right, well, here's something interesting. YouTube searches have increased on how to get into the stock market since yesterday. Is the retail public in trouble at all?
The retail public could be in trouble because we just talked about my cash level, which is a ridiculous 48%. I admit that's ridiculous. That's way too high. But overall, cash levels are very low. All right, cash levels are too low, which means that people are unduly euphoric. It also means that the money has to come out of somewhere to go somewhere else. You can't deploy capital that has not been yet deployed. So it's on top of the other reasons we just discussed to sell your profits in the tech space, now you have this forced selling because you want to get involved in the spaces that are going to benefit. The analysts are going to have to increase their earnings projections for those areas. And where are you going to take it from? You're going to take it from the stock that you're up 30, 40, 50, 100%. That's where you're going to take the profit so you can redeploy your capital. And that's what we're seeing.
Well, just in case things go wrong there, it looks like jobs are doing okay. As we saw in ADP, it was pretty hot. Now, an interesting headline I saw is an economist said that the job market could be overheating. What are your thoughts on that?
You will not see overheating. It is such a thing. An economy can overheat. It's not the stupidest thing in the world. It's a little stupid, but it's not the stupidest thing in the world. The economy will not be overheating until you see widespread consumer inflation. That's when you know the economy is overheating. If there's not upward pressure on wages, and if there's not upward pressure on consumer prices, then the economy is not overheating. Unemployment's very low. It's a 17-year low. It's almost a 19-year low, I think, if we get a little bit more help. That's fine. Right. But it doesn't mean that wages have gone up. And if wages don't go up, the regular person is still in a jam for much of this country. I was in a Dollar Tree last night. I go to a lot of stores and just check it out all the time because that's what I do. I'm an economist. Dollar Tree's crowded. Okay, I go to the mall. I went to the mall. Hello, hello, hello. Nobody. I walked through Sears. Nobody. Go to Dollar Tree. You got to wait in line. You can't get down the aisles. Why? Because people are looking for something they can buy for $1. It's the Christmas season, and they're hurting. And this is Long Island. Okay, this is what is considered to be an affluent area. Now you head out into the areas of the country that have not benefited as much from the recovery. What do you think it looks like there? I bet you it looks worse.
Yeah. Well, so then, would you be cool with the Fed raising rates next week?
I think we have to be. I think that it's written, it's in the cards already. It's probably priced in. We probably have a 60-40 chance at another rate hike come March, and probably a pretty decent chance at a third rate hike come June. So I think it's obvious the impetus is there that they want to keep raising rates. They want to normalize interest rates so that when trouble does strike, they are able to react. That is all well and good for the short end of the yield curve. However, if people don't start believing, and if deficit spending is not successful in pushing out the long end of the curve, the financials are all going to get in trouble. Even though people are buying them right now, come the first or second quarter, they're going to all hit a wall. I think the spread between the 2 and the 10-year right now is about only 0.50, right? We were complaining about 0.80. So now it's a much stickier situation. And if that yield should invert, it's a better than not chance that we're looking at a recession come 6 months down the road, maybe a little longer, but down the road. So I do think this is something that we have to worry about. I think if the curve becomes a little more closer to inverting, that they'll have to slam on the brakes. They're going to go in December, but they might have to slam on the brakes before that second or third hike.
Yeah, that is a whole other interview of discussion, the yield curve. That is a big one. And you know what? Maybe we'll touch on that next week. We have a special surprise for our viewers. We'll keep them guessing and let them know on Twitter. Stephen, I will see you there later, and thank you so much for joining me today.
Thank you for having me, Olivia.